As I look at the stock market for the last 5 months, the market in general has been going up 5 straight months. Is it going to keep going or is it out of steam? Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is April 2nd, 2024. As I looked at the stock market, I thought it just seems to be going up and up and up. I won't say, 1999, but, it's definitely been a solid market and a pretty consistent market, fooling a lot of people. The people who think, I think this, I think that, and that the market is overbought or that there's too much risk in front of us, etc., has fooled a lot of people. I've told you that we got in the market on the 4th day of November, just right after it began. We do that tactically. We don't do I think this, I think that, and have stayed in the market since that time and riding that wave, mostly being correct during that period of time. And but as I looked at it, I thought about the theme, "Happy Days Are Here Again," the song that came out in late 1929, right as the market had finished its long run up for a decade, the Roaring '20s, and began its descent down, dropping 88%. The Dow dropped 88%. Right as that happened, out comes this song, "Happy Days Are Here Again," that was adopted by the movie that came out the next year, 1930, Chasing Rainbows, and then was adopted by FDR in his presidential campaign in 1932. So and here we are. The economy is strong. The market has had more strength and resilience than many have expected. And where is it going from here? So I'm going to look at this from two perspectives. One is that it's going to keep going, generally speaking, and the other that it needs a correction. So we'll look at both sides of that. But for now, I thought I would do this. Just bear with me. I want to play you about 30 seconds worth of this song to set the theme of where we are now.
Happy days are here again, the skies above are clear again. Let us sing a song of cheer again. Happy days are here again.
So as I said, I'm going to play you two clips. One is from Morgan Brennan at CNBC, is interviewing Torsten Slok, chief economist for Apollo Asset Management, and he makes the case for a strong economy. Now, there are people who will say, "Oh yeah, they were predicting a bull market," and there's plenty of those, but many of those also always predict a bull market. So when the market is in decline or deep decline, they're still singing the bull market song. So I don't really pay attention to those. So anyway, but he does make the case, and there are many indicators, economic indicators, the consumer price index, the producer price index, the gross domestic product, strong employment, and when you look at the stock market, one of the measures of volatility, if there's increased volatility, that usually means declining stock market and vice versa. So when the VIX, the VIX, is a measure volatility index, when it is going down, that is a measure of a stable stock market. And the VIX has definitely been going down, coming way down to not far from its all-time lows, which means the market is right at its all-time highs. Both are approximately correct. So anyway, I'll play this clip for you with Morgan Brennan and Torsten Slok.
Housing starts falling sharply in January, down nearly 15% from December, marking the biggest drop since April of 2020. Joining us now, Apollo Global Management Chief Economist Torsten Slok. Torsten, it's great to have you back on the show. I'm going to start with a big, broad question for you, and that is the path back to 2% inflation challenging, absent more loosening in both the labor and housing markets?
That's a really, really important question, Morgan, because the issue is exactly with the housing market that the problem we have is that there are simply not enough homes for sale. In other words, the number of homes that are listed that's available for people to buy is still very, very low. And why is that low? Because remember, out of all homes that are sold, 7 of homes sold, 6 are existing homes, 1 is a new home. And for all existing homes, namely 6 out of those 7, people are basically sitting and leaning back and saying, I'm not offering my house on the market because I'm not leaving my 3%, 4% mortgage to go into a 7+ mortgage. So the problem is the upward pressure on inflation is coming back from the housing market. We have the Case-Shiller index is beginning to go up now 5% year over year. And given housing has a weight of 40% in the CPI basket, the short answer to your question is that in particular from the housing market, we're at risk of seeing renewed upward pressure on inflation. And also to your other point about the labor market, likewise, wage inflation still remains relatively strong. So that also continues to be an upside risk to inflation.
Okay. So I know you've been on this show and you've been on CNBC in the past, and you've talked about the possibility of a no landing scenario here for the economy. When you look at the data we got this week, whether it is CPI and PPI or even some of the other reads that we've gotten, including claims which continue to be stubbornly low here. Is this January effect playing out in the data, or is this early evidence perhaps that we are in a no landing scenario?
I think you're right. This is early evidence. And why is it early evidence? Because remember, the Fed pivoted at the December FOMC meeting on the 13th of December. They basically began to say green light for issuing more IG. And that's exactly what you saw. Record high issuance of IG in January. The multi-year high issuance of high yield, also loans coming back. You also saw M&A activity coming back. You also saw IPO activity coming back. With that backdrop, it's not really surprising that the employment report was strong in January. And likewise, therefore, it's not really surprising that also the CPI and PPI reports, in particular coming from services, have also started to pick up. So I think it's much more fundamental that the Fed essentially changing their tone as they did at the meeting in December. That's the reason why the data is now showing more signs of improvement. So that's why I do think that we will see more hawkishness from the Fed, so that they have to begin to talk more in the direction of saying, well, there is a risk that we might actually have rates higher for a lot longer than what the market currently is expecting.
Now, the opposite point of view, and this is from Scott Wapner is interviewing Morgan Stanley's Chris Toomey, and he has a lofty title at Morgan Stanley, and they believe, and he believes, that they are ready for a correction. And he has been saying this for some time. I don't track his quotes per se, but I would suspect that probably at least a year he's been saying this, and Scott Wapner points that out. And so when you get into asset management, portfolio management, and you have that view and your portfolio reflects a defensive or negative tone to it, you're missing out on upside opportunity. So, but, you know, Scott Wapner gives him a chance to correct what he's been saying, but he really does it. I mean, he kind of doubles down on it. So, but if you have the view that the market is overvalued and is ready for a correction, and I'm going to say a correction might mean 10%. Maybe it means 10 or 15%. Not a market crash, but a correction. I don't know what he means, so those are just numbers that I put out there. But if you think that, you will probably resonate with what he has to say. If you are more optimistic and you think the market is going to keep on going, that it's got a head of steam and going to go up before it goes down, then maybe you would agree with the last interview. But I'm going to play both of them so you can hear both sides of the story. So take a listen.
Morgan Stanley's Chris Toomey runs one of the highest rated private wealth advisory teams in the country. He joins me here at Post 9. Well, you're consistent. I'll give you that. But why are you still negative? I'm trying to think, you know what? when I knew you were coming up, I'm like, how am I going to handle this interview? I feel like I ask you the same questions every time.
Yeah.
Because I have no choice.
Right.
But, I mean, at some point, as this market, as we just said, is off to its best start in 5 years, you would think that your position would change.
Right.
Why hasn't it?
I think it hasn't because while we have seen tremendous economic growth that we weren't expecting, we've seen inflation come down, we've seen a very strong labor market, the things that we're concerned about continue to be things that we're concerned about. And I think why we're particularly concerned right now and why we think this rally is so remarkable is I think if you look at the pace over this period from October to now, we actually have not even seen a 2% correction. And over that time period, we haven't seen something like that in over 6 years. If you look at all of these sectors that are doing well, on a technical basis, they're all either overbought or extremely overbought. So in our mind, I think even on the short term, we would all agree that the market could probably take a breather. So I think from a technical standpoint, from where we have been, I think it wouldn't surprise us to see a pause or, more importantly, probably see a pullback given how far we've moved and how aggressively we've moved.
Okay.
So that's all I've got for you today. I just wanted to tell you that I think we've got a strong market, and if you take the most negative view, I think the most negative view you probably could say now is that the market is probably going to have some kind of a pullback or some kind of a correction. Or you take the other side and say, I think it's going to keep going before that happens. I do want to point out, and if you watch me for a while, you know that this is how I think. When you look longer term, and I'm going to say 2 to 3 years or more, that the market has got a lot of deep risk in it. The market is, at some point, going to have a deep decline. When I look at what could cause that from here, my point of view, it is debt, it is printed money, and various other kinds of economic risk. Overvalued stocks, overvalued real estate, which sets the stage for some kind of event that comes along that drives it down. I don't think that's around the corner. Maybe I'm wrong, but I'm just going to say it. I think right now we have either a continued up market or some kind of a relatively minor correction and then a continued up market. So thank you for watching. If you have questions or comments, leave them in the comment section below. Thank you.
Happy day.